Hello everyone. Welcome to our weekly lecture. Today we are in week 6 and I'm going to cover the topic of consolidated financial statements, which include a single subsidiary and an associate. This topic is mainly building on your previous knowledge of the preparation of consolidated financial statements, which is include only a single subsidiary. So we are moving forward by introducing a new type of investment, which is an associate. So the presentation that we having today include learning objectives, so which means the main learning outcomes that we need to achieve by the end of today's lecture, and then outlining the course from week 1 up to week 6. And then we'll start to introduce the associate, starting with the definition, and then we'll move to the accounting treatment in consolidated accounts. And then we'll use a practical example to explain how to prepare consolidated financial statements, which include an associate and a subsidiary. And then we finally move to the preparation for the workshop this week, which include reading, and the background reading, and also the exercises that you need to solve before coming to the workshop. The main learning objectives that we are covering today include two main objectives. The first one is about how to prepare a consolidated statement of financial position, which include a single subsidiary and an associate. And then we'll move to the second learning objectives, which include the preparation of consolidated statement of profit or loss, including an associate and also a single subsidiary. So looking at what we covered so far, so we're starting in week 1 by looking at an overview of financial statements of a single company, and this is mainly the main financial statements and the accounting treatment of different items in financial statements, which include a statement of financial position and a statement of comprehensive income. And in this week, we mainly try to link the knowledge that you acquire at level 5 with the expectation for level 6. And then we started with the explaining the principles of consolidated accounts, which include the definition of groups and also the different definition about parent company, subsidiary, and how the parent company control the subsidiary. And then we'll move to how to prepare a consolidated statement of a financial position, and this is mainly has different parts. The first part and the second part, which is mainly covering different issues related to the preparation of consolidated statement of financial position, including fair value adjustment, intra-group trading, and intra-group transactions. And also we cover in week 5 the consolidated statement of profit or loss and comprehensive examples, which include the preparation of both consolidated statement of financial position and consolidated statement of profit and loss. From here, we start to move to our next subject, and our next subject is preparing consolidated financial statements, which include the associates as well as the subsidiaries. Starting with the definition of an associate. This topic is mainly we use International Accounting Standard 26, and this standard mainly cover the definitions and the accounting treatment of the investment in associate and joint venture. So if you go through this standard, you will see the different definitions that we are covering here and the accounting treatment of the associate. So starting with the definition of associate. The associate is mainly defined in this standard as an entity over which the investor has significant influence. And this may differ from the definition of the subsidiary. So the subsidiary is mainly about control, but associate is about significant influence. And there is a huge difference between the two definitions. So for control is about investors control an investee when the investor is exposed or has the right to variable return from its involvement with the investee and has the ability to affect those returns through its power over investee. Okay, so the control concept is mainly give the right and obligation to direct the policy of the subsidiary. On the other hand, significant influence is giving the power of the investor to participate in the financial and operating decision of the investee. Okay, so and this is mainly slightly less influential than the control. Okay, so it is not control, it is neither control nor joint control. So control in the case of subsidiary and joint control in the case of joint venture. So we already mentioned about the control, but joint venture is about sharing the ability to direct the policy of the company. So it is neither party is able to mainly control the whole process of financial and operating decisions, but it is jointly controlled. And there are some indications of the power to participate. Okay, so it may include representation on board of director or material transactions between the investor and the investee, and interchange of management personnel, especially top management, provision of essential technical information. So if there is provision, technical information are provided by the investor or the investee, this mainly give them the power to direct or participate in the financial and operating policy of the investee. And there is some indications about assuming the existence of significant influence when the investor hold 20 to 50% of the voting shares of the investee. And this may be subject to evidence to contrary, which means that we need to look at the indication about representation on board of director, material transaction, interchange of management personnel, and whether this exists or not. And this may give evidence about whether the significant influence exists or not. Moving to the accounting treatment. Okay, the main method in an accounting that we use to account for subsidiary in consolidated financial statements is mainly known as the equity method. Okay, and the equity method is a method of accounting whereby the investment is initially recorded at cost and adjusted thereafter for the post-acquisition change in the investor share of net assets of the associate, and also it take into account the investor share of the profit of the associate when we come to the statement of profit or loss. Equity method must be used unless the associate is merely held for sale. Okay, if the associate is merely held for sale, in this case, the investment in associate will be classified as held for sale according to International Financial Reporting Standards number 5, and it will not be included as associate. Another exception is mainly when the parent company is exempted from preparing consolidated accounts, and this case when the parent company itself a wholly or partially owned subsidiary of another company, and this mainly according to International Financial Reporting Standards number 10. Now we'll start applying the equity method in the preparation of consolidated statement of financial position. Starting with subsidiary. Subsidiary, we already know about it in the previous weeks. So the rule here for the subsidiary, all assets and liability are consolidated on a line-by-line basis, which mainly called for full consolidation. We'll see now the summary of the full consolidation method. So if we have the statement of financial position of the parent company and the subsidiary, so we're starting here with calculating the value of goodwill, and the value of goodwill is mainly calculated by comparing the value of the subsidiary acquired to its net assets, and the value of the subsidiary acquired, it can be the value of acquired by the parent company if the subsidiary is 100% owned by the parent company, and if the parent company own less than 100%. So in this case, there will be what is known as non-controlling interest. So if the case include non-controlling interest, so in this case, we need to consider the value of non-controlling interest, and the value of non-controlling interest at acquisition date can be calculated using two alternative methods. The first one is mainly called proportion of net assets method, and the second one is the fair value method. If the first method used, which is mainly proportion of net assets method, so in this case the value of goodwill will be attributable to only the parent company. If the alternative method used, which is the fair value method, so in this case the goodwill calculated here will be attributable to both the parent company and non-controlling interest. Following this adjustment, so we mainly work out another adjustment, which is mainly the non-controlling interest at reporting date. And the non-controlling interest at reporting date start with the non-controlling interest at acquisition date and adjust this value by the post acquisition changes in retained earning of the subsidiary. And finally, we mainly work out another adjustment, which is mainly related to the group retained earning. And the group retained earning is mainly the retained earning of the parent company, and this is mainly adjusted by the retained earning after acquisition, which is mainly post-acquisition retained earning. We focus mainly on the group share of post-acquisition retained earning. Then we are ready now to produce the final group statement of financial position, and this will be by eliminating the investment in subsidiary at cost against the equity of the subsidiary, which include the share capital and the retained earning of the subsidiary, and then all other items will be consolidated line by line, which is mainly adding the similar items together in the financial statement of the parent company and the subsidiary. And finally, we produce the consolidated statement of financial position, which include only a single subsidiary. Moving now to the associate, and the associate here, according to the equity method, will be classified under non-current assets. So they are initially recorded at cost, the cost of investment, and then will be adjusted in following years by adding the investor share of post-acquisition changes or post-acquisition profit. The steps here for the associate start with having the statement of financial position of both the parent company and the associate. And when we apply the equity method, in this case, what we need is to pick up two figures in the statement of financial position of the parent company, which is the investment in associate at cost and the retained earning of the parent company, and adjust both figures with the investor share of post-acquisition profit of the associate. Okay, and this may be called one-line consolidation. One-line consolidation because we only we don't need to go through all the detailed item of the assets, liability, and equity of the associate and the parent company. We just picking up the investment in the associate at cost and the retained earning of the parent company, and adjust both figure with the investor share of post-acquisition profit of the associate. And then we produce the final format of the consolidated statement of financial position, which include only adjusting the investment in the associate and also the retained earning of the parent company with the investor share of post-acquisition profit of the associate. Okay, so looking at the example, so we have in the example three companies. The three companies here are the parent company B, the subsidiary S, and the associate A. And we have several items here related to the statement of financial position of the three entities. And then we have additional information. The first piece of information, we have B acquired 75% of the equity share capital of S, which is a subsidiary, several years ago, paying 5 million in cash, which is the cost of investment. At this time, the balance sheet of S retained earning was 3 million, which is mainly the retained earning at acquisition date. So we're starting here using this information to calculate several items. So we have the first step here is to start with the group structure. So we have subsidiary S. So the group share is 75%. Okay, which means that the non-controlling share is 25%. And this mainly from additional information I. Okay, and the next one we have the associate, the next item here. B acquired 30% of the equity share capital of A. A is associate on the 1st of October 2006, paying 750,000 in cash. And at the 1st of October 2006, the balance of A's return earning was $1.5 million. Okay, so this means that the investor share is 30% in the associate. Okay, and then we'll move to the second step is to determine the net assets amended by fair value if it is different from book value at the reporting date and at acquisition date. So we're starting here with the share capital and retained earning at acquisition date. So the share capital, we assume that the share capital is the same unless there are especially mentioned. So we have for the subsidiary, which is S, share capital is 1,000. This is mainly the same amount of capital, 1 million, because the figure here in 1,000. So it is 1 million in both the acquisition date and reporting date. For retained earnings, so retained earning here at the reporting date is 5,500. So this mainly at the reporting date 5,500, and then we have the retained earning at acquisition date, and returning at acquisition date is mentioned in further information I. It is 3 million, so which is here 3,000. Okay, and this mainly is the information that we need to work out the net assets at acquisition date and at reporting date, because we don't have any additional information about fair value adjustment. So there is no fair value adjustment. So in this case, we assume that the fair value of the assets and the liability of the subsidiary are equivalent to the book, their book value. And we have here post acquisition profit, which is the difference here between the retained earning at a reporting date and the retained earning at acquisition date. So we have 2,500,000, and there is no change in the capital. So this means that we only have the 2,500,000. This means the post acquisition retained earning. So this mainly the next step. So we have for the associate. So for associate, the capital, share capital is 500,000, and this mainly the same amount in both reporting date and acquisition date. So we assume there is no change in the capital. And if we see this further information II, we have here the retained earning at acquisition date. It is mentioned as 1.5 million, which is mainly here 1,500. This mainly at acquisition date, and at reporting date we have 2,500,000. So this means that we have both acquisition retained earning 1 million. Okay. There is no change in the capital, in the associate capital. Moving to the next step here is to work out the goodwill at acquisition date, which is mainly called goodwill at on consolidation. So we have cost of investment. So cost of investment, this mainly the amount paid by the parent company to acquire the subsidiary, and this amount is mentioned here in the first piece of information, which is about 5 million in cash. So this mainly the cost of investment. So this mainly 5 million. Okay, so this mainly the cost of investment, 5 million. And we need to look at the fair value of non-controlling interest at acquisition date. If we see here in item VI, non-controlling interests are valued using the fair value method, and the fair value of the non-controlling interest in S at the acquisition date was 1.6 million. So this mainly 1,600,000. And this mainly the total value of the subsidiary, which is 6,600,000. Excluding from the value of the subsidiary is a fair value of net assets at acquisition date. The fair value of net assets at acquisition date is already calculated here in the above working. So we have for million. This million is the fair value because there is no difference here between fair value and book value of the subsidiary. So it is 4 million. So it's minus 4 million. Then we have the goodwill at acquisition date, which will be the same amount at on consolidation. So 2,600,000 because there is no goodwill impairment in this example. Okay, so moving to calculating the group retained earning. So calculating the group retained earning start with the parent retained earning as the reporting date, and this is mainly given here in the statement of financial position of the parent company is 7,500,000. And then we add to this figure the group share of post acquisition profit of both the subsidiary and associate. So we have for the group share of the subsidiary is 75%, and the post acquisition profit of the subsidiary is here calculated in the second adjustment, which is mainly 2,500,000. So it's 25% out of the 2,500,000. So which is mainly 1,875,000, and then moving to the group share of post acquisition profit of the associate. So the associate here, the investor share, the group share is 30%. Okay, and the post acquisition profit of the associate is mainly in the second working is 1 million. Okay. So 30% out of the 1 million, which is 300,000. Then moving to group trading. So intra-group trading. So for intra-group trading, we have two items, item 3 and item 4. So for item 4, which we have balances here, the balances with the associate. So we have trade receivable and trade payables, and the rule here generally the associate is considered to be outside the group. So this means that the balance between the group companies and the associate will remain in the consolidated statement of financial position. So this is mainly applied to balances like account payable and account receivable. Okay, but for the inventory and the unrealized profit, this mainly need to be excluded to the extent of the investor share, which is mainly 30% in this case. So in this case, we need to work out the unrealized profit on inventory. So we have here the sales is 1 million between the associate and the group. So we have 1 million sales, and the 1/4 of these goods is still in the warehouse. So multiplied by 1/4, which is mainly 250,000. This is still in the warehouse. This will be multiplied by the markup. The markup here we have 25 markup out of 125. So this will give us the unrealized profit, which in this case is 50. So this mainly 50 is unrealized profit, and the group share is 30% of this amount, which is mainly 50 times by 30%. So which is 15, and this mainly excluded. Okay, so it's minus. Okay, so this mainly is the group share in the unrealized profit on inventory. And then we move to another item that is mainly affecting the group retained earning, which is mainly impairment of the associate. Impairment of the associate is mainly given in item V. So at 30th of September 2008, it was determined that investment in associate was impaired by 35,000. So 35,000 is the amount of the impairment, and this mainly reducing the group retained earning. So minus 35. Then we have the consolidated retained earning. So it's just adding up this figure. So it is 9,625,000, and this means the consolidated. Okay, so moving to the next item here, which is mainly the non-controlling interest in net assets at reporting date. So we already have the non-controlling interest, and this is mainly given here at acquisition date. So non-controlling interest at acquisition date is calculated here or given when we calculate the goodwill. So it is 1,600,000. This is mainly given. So this will be adjusted by the post-acquisition retained earning of the subsidiary. So this may be applicable to only the subsidiary. So we have 1,600,000. This is mainly the fair value of non-controlling interest at acquisition date, and this will be adjusted by the non-controlling share. Non-controlling share is 25%, and this may be multiplied by the post-acquisition retained earning of the subsidiary, and the post-acquisition retained earning of the subsidiary is already calculated here in the second adjustment, which is mainly 2,500,000. So if we work out this figure, okay, so this will be $2,225,000. Okay. And then moving to the next item that we need to work out, which is the investment in associate. So the investment in associate. So we need first for the associate the cost of investment at acquisition date. The cost of investment at acquisition date, and the cost of investment at acquisition date is given in the second additional information here. So we have B acquired 30% of the equity share capital of A on the 1st of October 2006, being 750,000 in cash. So this is the cost here. $750,000 in cash. And then we add to this figure the investor share of post-acquisition profit. So remember that we have the investor share in the associate is 30%, and the post-acquisition profit in the second working is 1 million. Okay, so this may be 300,000. And the less investment impairment, this mainly given in additional information number V. So we already have it before when we calculate the group share, group retained earnings. So we have 30 minus 35. This will be here again, minus 35. And also less the group share of unrealized profit on inventory. So this is the group share. And this also calculated here in when we work out the group retained earning, which is minus 15. And then we get the investment in associate at reporting date. So the cost of investment adjusted by the investor share of post acquisition profit, and also with impairment in the investment, and also with the group share of unrealized profit. So this will give us the group so the investment in associate at the reporting date. So this is mainly all the working here, and then we'll move back to include all this calculation in the consolidated statement of financial position. Okay, so we're starting with the goodwill that we already calculated. We have goodwill on at acquisition date, which is mainly on consolidation. It is 2,600,000. So 2,600,000, and this mainly according to working 3A. Okay, so this is the goodwill. And then we have the next item is that we calculated here is the group retained earning. Okay, and the group retained earning is 9,625. 9,625. And this mainly according to working 3B. And the next item that we calculate also is non-controlling interest in net assets at reporting date. So the non-controlling interest is 2,225, and this mainly according to working 3C. And next we have the investment in associate, and the investment in associate is calculated here as 1,000. So this mainly 1,000, and this mainly according to working 3D. Okay, so this is all the working, and then the next step is mainly simple aggregation of the parent plus subsidiary of all other statement of financial position items. Okay. Investment. So the investment here, the total amount of the investment is 10,000. 5,000 is related to the subsidiary. We have 5,000. This needs to be excluded. And another 750. This is related to the associate. So the remaining balance of the investment is 10,000, take away 5,000, and then take away 750. So this is the balance that should be included in the consolidated statement of financial position, and the 5,750 should be excluded. Okay, and then we have the next item, property, plant, and equipment. And for this item, it is simple aggregation of the parent and subsidiary. So for the parent and subsidiary, it is 14,000 plus 7,500. So which is 21,500. And then we move to current assets. This is also applicable to the parent and subsidiary, which is 9,000. So this merely the total here is 9,000, which is the sum of 6,000, which is the parent current assets, plus 3,000, which is the subsidiary current asset. Then we have all the assets now calculated. So we just need to add them up to get the total assets. So we have the total asset here is 38,350. And then for share capital will only applicable to the parent share capital. So this is mainly parent share capital. And the capital of both the subsidiary and the associate will be excluded in this context. So we have the share capital for the parent company is 10,000, and then we get the total equity, which is the sum of share capital plus group retained earning plus the non-controlling interest. And then we have non-current liability. So for non-current liability, this is also applicable to only the parent and the subsidiary. So 8,000 plus 1,250. And current liability, so also applicable to the parent and subsidiary, so which is 4,500 plus 2,750. So the total here is 7,250. So if we add them up, now we get the total liability and equity. So total equity 21,850 plus 9,250 plus 7,250. So the total is 38,350, and this merely equivalent to the total assets, and this merely is the solution to the this example 1 about consolidated statement of financial position, which include a single subsidiary and associate. Okay, continue with the use of equity method. So we'll move now to the use of equity method in the preparation of consolidated statement of profit or loss. Okay, so for the subsidiary, the rules here is all revenue and expenses are consolidated on a line-by-line basis, and a summary of the steps that we follow here. So if we have a statement of profit or loss for the parent company and the subsidiary, so the first step here, if there is any investment income received from the subsidiary, this needs to be excluded, and this will be replaced by the detailed items in the statement of profit or loss for the subsidiary. So So the next step here is to aggregate revenue with revenue and expenses with expenses for both the parent and the subsidiary. And the result here will be the group statement of profit or loss. And this group statement of profit or loss aggregating the revenue and expenses of the parent company and the subsidiary. And in the end, we have the profit for the year, and this profit need to be split between non-controlling interest and the parent investors or the parent owners. Once we did this split, so we mainly prepared the consolidated statement of profit or loss for the year, which include the parent and the subsidiary. Moving to the associate. So the associate, if we have investment in associate, so it will be the accounting treatment according to the equity method is a single line after profit from operations, and this single line will include the investor share of the associate profit after tax. So this mainly the accounting treatment of the associate. It is one line consolidation. So one line consolidation, it is only we include the investor share of the associate profit after the tax. So this mainly a summary here. So if we have the parent and the associate, so what we need to do is if there is investment received from the associate, this investment income need to be excluded, and then will be replaced by the investor share of the associate profit. Okay, so we are now ready for example. So the example that we have, so it is example number 2, and this example we have the statement of profit or loss for 3 companies, B, S, and A. B is the parent company, S is the subsidiary, and A is the associate. And for the 3 company, we have several items in the statement of profit or loss. We have revenue, operating expenses, finance costs, income tax expense, and then the profit for the year. And we have additional information. B acquired 80% of S several years ago, and B acquired 30% of the equity share capital of A on the 1st of October 2006. During the current year, B sold goods to A for $1 million at a markup of 25%. At the year end, A still held 1/4 of these goods in inventory. And then we have at 30 of September 2008, it was determined that investment in the associate was impaired by 35,000, of which 20,000 related to the current year. So this mainly all the information that we have, and the main requirement is to prepare consolidated statement of profit or loss for the year ended 30 of September 2008. So we'll use this information here to prepare the consolidated statement of profit or loss. So for the subsidiary S, we have the group share, which is 80%. Okay, and then this means that the non-controlling interest share is 20%. And for the associate, we have the group share here, or the investor share is 30%. Okay, and then the next step is to eliminate any investment income received from the subsidiary or the associate. So we don't have any investment income received from the subsidiary or the associate. So we'll move to the next step is single aggregation for the profit and the subsidiary of all other items. So we're starting here with the revenue. So for the revenue, we mainly aggregating only the parent and subsidiary. So we have 8,000. This is the parent revenue, and the subsidiary revenue is 4,500. So the total here is 12,500. And then we move to the operating expenses. We have for the parent is 4,750. Plus for the associate, it is 2,700, and then we get the operating expenses. Okay, and then the difference here between the revenue and operating expenses is the profit from operations. And once we work out the profit from operation, we mainly move to look at the investor share in the associate profit. So we have the associate profit here, which is single line consolidation. So we have the associate profit is 600,000. And the investor share in this profit is 30%. But this profit needs to be adjusted by unrealized profit on inventory and any impairment in the investment in associate which is related to the current year. Okay, so we have these two items here given. So we have during the current year, B sold goods to A for 1 million at a markup 25%. So this is mainly intra-group trading, and for intra-group trading, the associate is mainly considered as outside the group. So in this case, intra-group trading will not affect the revenue and the cost of goods sold. Okay, so but the only impact here on the associate profit is the unrealized profit on inventory. So in this case, we have 1/4 of the goods is still in inventory. So this will impact on the associate profit. So we need to exclude 30%, which is the group share, times by 1 million, which is the sales, times by 1/4, which is the items that remain in the inventory, times by the markup, which is 25 over 125. So this will give us the group share in unrealized profit on inventory. And then we have also the impairment of the investment in associate, which is related to the current year, which is 20,000. So this will be excluded as well here. So then we are ready to work out the investor share of the associate profit. So this will be 600 times by 30%. And then 30% of the 1 million, which is the sales, and times by 1/4, which is the inventory, and then times by 25 over 125, which is the markup, and then exclude the impairment of the investment in associate. So this will give us the share of associate profit. And then moving to the finance cost, and this is mainly related to the subsidiary and the parent. So we have for the parent, finance cost is 750 plus 100, which is related to the associate. So the total here for finance cost is 850. So this will be excluded. And then we have now the profit before tax, which is the profit from operation plus the investor share in the associate profit, and then exclude the finance cost. So this will be the profit before tax. And then we have the income tax expense, and this also aggregated for the parent and the subsidiary. So we have 700, this mainly for the parent, and for the subsidiary it is 500. So the total here is 1,200. And if we exclude this amount from the profit before tax, so we get the profit for the period. So the profit for the period is 3,145. And then we need to split this profit between the non-controlling interest in the subsidiary and the parent owners. So we have for the subsidiary, so we have the non-controlling share is 20%, and the subsidiary profit is 1,200. So we get the non-controlling share in the profit, which is 20 times by 1,200, so this mainly 240, and then the difference here between the profit for the period, which is 3,145, take away 240, which is the non-controlling interest share in the subsidiary profit. This will give us the profit attributable to the parent owners, so which is 2,905. So this is mainly the numerical example that is mainly covering the consolidated statement of profit or loss. We'll return back to the slides. Okay, we're moving now to the preparation for the workshop. So what you need to prepare to get the workshop for this topic. So we have two types of preparations. The first one is about reading. So we have several sources of reading. So we have accounting standards. So we have International Financial Reporting Standard number 10, which is about consolidated financial statement, and International Accounting Standard 28, which is investment in associate and joint venture, and International Financial Reporting Standard number 3, which is business combination. So this mainly the main standards that you need to mainly read as preparation for the workshop. And also we have different sources of textbooks. So we have a professional textbook, which is mainly ACCA. You need to mainly read chapters 16 to 19, or you can use also academic textbook like Elliott and Elliott and Alexander and others. And for this textbooks, so you have also different chapters, so you can mainly visit more than one source to mainly prepare for the workshop. Then we move to some exercises. Okay, so you can use different type of exercise here. I have prepared some exercises on Google Docs, and this is mainly to test your knowledge of subsidiary, and also some of the principles that we cover for associate. At the same time, you can also visit the publisher textbook, which is mainly McGraw-Hill Connect, and this also include plenty of online questions. So and thank you very much. See you in the workshop.